Wait.
Mike, you're on mute.
Why is it going on like that? Can you hear me? Can you guys hear me okay?
Yes.
All right. Thank you. Sorry about the technical difficulties. I'm a little bit challenged today, but we're live here on LinkedIn, YouTube, and Twitter. Thank you, everyone, for joining, and welcome to Showcase Broadcast Studios. My name is Michael Wardy. I'm a Senior Strategic Director here at Source Advisors, where for over 40 years, we've been working with CPAs and clients in various areas of the tax incentive programs. Today's presentation, which I'm really appreciative of having the gentleman in studio with us today, is talking about the 174 amortization issues. I know we had a presentation, Brian and Jim, I think it was a couple weeks ago, that we were on LinkedIn Live and presented about this. And we have David Maass with Flightware joining us today because of what's going on with amortization of 174 and the impact it is having potentially on the SBIR program. So David, thank you for joining. We appreciate it. I know you have a lot of insight information that we want to bring it to everyone's attention. If anybody has questions, thoughts, comments, go ahead and share those on LinkedIn, YouTube, or Twitter. We'll try to get to those. If we don't, we're not ignoring you. We will get your questions answered post the presentation, the discussion today. Just as an introduction, Jim Foster, he's been with Source Advisors. He came here in 2022 and has focused on tax incentives such as R&D, disaster relief credits, and the ERC, more recently, 174 amortization. Jim's been practicing in the general area of taxation and tax law for 15 years and has produced numerous successful tax credit cases for his corporate clients. Further, he has had successful tax audits that range from IRS audits and appeals to state level tax audits. I know a lot of people know Brian and know Jim and know David, but Brian Coddington has been providing compliance consultation and audit representation services in the areas of tax accounting methods and credits. Brian's represented tax payers before the IRS in matters involving LIFO, UNICAP, cost segregation, R&D claims, and he has represented his clients before the IRS National Office and in numerous accounting methods and changes. David Maass is the president of Flightware. It's a small business and has been active in the SBIR program almost since its inception, close to 40 years ago. Congratulations, David. Between Flightware's own contracts and Flightware's clients, he has been involved with more than 50 SBIR contracts, from initial proposals to contract management and eventual commercializations. David has worked for large defense contractors and then started and managed 2 small businesses. He has a degree in aerospace engineering from MIT. Again, gentlemen, welcome. I know I went through that very quickly because I want to get to the crux of everything that we want to discuss. Here's how I'd like to start, if it's okay. I want to bring everybody up to speed on 174, what the impact is. And then, David, I want to have you jump in. Let's take a couple minutes to go through 174 and amortization. And then, David, have you jump in and talk about what's going on with the SBIR program and the impacts behind that. So I'm going to share my screen real quick. And Jim and Brian, you guys can talk a little bit about the industries impacted, where we're seeing a lot of it happening, and then we'll go on to some examples.
So what we've got here are a lot of industries that are impacted by 174 amortization, but this list is by no means exhaustive. We've highlighted the software development, financial services, and video game developers because they deal with software a lot. And software is now automatically part of 174, essentially, if you're doing software development. But that's by no means the only industries that have software. If you're doing internal use software, meaning your ERP systems or your manufacturing line software or something like that, you need to look at this for 174. If you are developing any sort of product or manufacturing process, such as manufacturing, automotive, plastics, metals processing, things like that, then you need to be looking at 174 as well. Let's hop to the next slide, Michael. So in the R&D credit, we have 4 categories of direct costs: wages, computer costs, contractor costs, and supply costs. The wages use the taxable wages and are for direct costs on the research, direct research, direct supervision, direct support. Computer rental or lease costs are basically your cloud computing costs for development purposes. Contractor costs, and this is something that'll be very important today. If you're qualifying for the R&D credit, you get to take 65% of the amount, provided that you retain the rights and risks. And if you don't have the rights and risks, you're not entitled to it underneath 41. We'll get to 174 in just a second, where that might not be the case. And then supply costs, there's certain raw materials and consumables that you can include. 174 generally includes all those costs, but it also includes the gross wages and other payroll costs for the individuals, not the taxable wages. It includes overhead, office supplies, occupancy costs, patent costs, software licenses, utilities. This is not an exhaustive list for 174. It's the kind of generalized categories, but when you go into your profit and loss statement, you have to look at each general ledger item and find out if that's related to the development costs that you need to qualify for 174. And it's a facts and circumstances driven analysis. Next slide, please.
Absolutely.
High level, just to illustrate this, and I think David's going to cover this a little bit also. If you are amortizing your cost in year 1, if you have $1 million in research expenses, you only get to take a deduction of $100,000 in year 1. That's 1/10. The 90% that's left over stays in income, and you multiply that by your max tax bracket. Most likely, if you're at $1 million in research expenses, you probably are in the max bracket. For flow-through entities, that goes to your personal return. That's going to be 37%, which means your additional tax increase from 174 is going to be $333,000. Now, if we're assuming you're using the reduced credit for whatever reason, the reduced credit would be about $55,000, which means your overall net increase would be $277,000. The reduced credit here, in most instances, now is not the best way to do this. And so if we go to the next slide.
Sorry.
That's all right. You're going to see that the gross credit would be $70,000, and you're going to save an additional about $100,000 over the first 6 years of liability, and you're going to get ahead quicker. You still have the same increase in tax from 174, but now you're reducing it further using that gross credit. Now, in most instances now, you do not need to add back the gross credit to income. That is the old 280C rules. With the new 280C rules, you only have to add back the gross credit amount that exceeds 10% of the qualified research expenses being amortized for that year, or being taken as the deduction for that year, I should say. So if we go to the next example, and I'm moving relatively quick because I want to get to David's presentation. Absolutely. And then I want to get to the questions. So in this example, we have taxable income of $1.5 million, which would result in taxes at 37% of about $555,000, research expenses of $1 million, amortization of $100,000 as your current year deduction. So we add the $900,000 to our income because we don't get to deduct that. That gives us $2.4 million in income, which gives us the revised tax liability of $888,000. In this instance, I'm hypothesizing that the gross credit is $140,000. That exceeds the amortization by $40,000. So we would add back $40,000 to the 174 expenses, which would give us a revised amortization amount for year one of 96. That's going to change our revised taxable income to $2,404,000, which is going to ultimately give us tax savings of $138,520, which is pretty darn good. We're going from 140 to 138. That's not much of a haircut. If you had elected the reduced credit, the 110,600, you would have gotten the 110,600. So this is, even when the gross credit exceeds that amortization amount, you still want to elect the gross credit most likely, at least for the federal purposes. There may be state tax implications that you need to evaluate as well, but for federal purposes, this is the best way. With that in mind, I want to turn this over to David. If you have questions on this slide, we can always come back to it. But let's turn this over to David and see a little bit more of how this is impacting SBIR.
Thank you. Okay, I have a few slides that I hope will explain to the non-CPAs in this audience what the problem is, efforts to fix the problem, and how it directly affects you on your tax return. And the numbers that I have one slide with numbers. They're a lot simpler than what Jim showed, but I'm trying to make it simple for people who are not CPAs to understand. So first of all, for the CPAs in the audience, I have a very quick couple of slides to say what is SBIR in case you're not familiar. There was a massive change in the taxes that SBIR firms have to pay associated with the work they're doing for the government last year, which are people are only now seeing this year when they complete their 2022 tax return. This impacts not only the SBIR companies themselves, like my company, it also impacts the government folks whom this work is being done for. And in my opinion, this tax, if it is not changed, effectively kills the SBIR program, and I'll tell you why. So there are two things that people need to worry about, SBIR companies. One is, how do I deal with my 2022 taxes? And for that, you need a CPA like Source Advisors, either as a consultant to your CPA, what have you. But then the other thing, which is a little bit longer term, I hope not too much longer, is what can we do to fix this? So let's get into it. SBIR stands for Small Business Innovation Research Program. It was established by law about 40 years ago. And it basically said, look, if a small company is trying to compete with Boeing for the R&D activity the government wants, it's not going to be very successful. And therefore, they set aside a very small percentage. I think the current percentage is 2.5% of government R&D money. And obviously, the government spends a huge amount in R&D, specifically for the SBIR program. One thing that's really important to understand is that it is very popular in Congress. Unfortunately, the way the SBIR law was written, it's called sunset legislation, which means it has to be renewed typically every 5 years. So this has happened quite a bit. The last time it was renewed, which was at the end of last congressional session, the renewal of SBIR passed the House by a vote of 415 to 9. The reason that's important is you don't see bipartisan support for almost anything today. And so I'm hoping to leverage that bipartisan support for small businesses and the SBIR program in particular as part of the approach to how do we fix this. Again, all federal agencies over a certain amount have to participate in SBIR. Most of my work has been for the Defense Department. That sucks up about 60% of all SBIR funding. In 2019, which is the last year that statistics are available, there were 7,000 SBIR and STTR contracts awarded. Some of those contracts are multi-year contracts, typically 2-year for what they call phase 2. And so I estimate that there are about 10,000 small business contracts active today. which means that there are on the order of 10,000 small business SBIR firms like mine that are facing this problem. Overall, over the 40 years that SBIR has been around, it has contributed greatly to the United States economy. There have been close to 180,000 contracts awarded to small businesses worth $54 billion. A lot of great technology has come out of those contracts. 700 companies, which are now public, frequently started as small business contracts and developed their products and services with SBIR money. Qualcomm, for example, started as an SBIR company. And the main reason that, one of the justifications for SBIR is that there have been lots of studies done that show that if you're going to spend $1 in R&D, small businesses are about 10 times more efficient converting that R&D funding into a permanent job. That R&D develops new products and services. Those services get commercialized. And if you're going to spend $1 million with Boeing to develop something, and you're going to spend $1 million with a small business, the small business is much more likely to create real jobs associated with the commercialization of that technology. Now, unfortunately, everything changed as far as the economics of doing SBIR contracts in 2022. And the reason it changed was because of the tax cut bill, which is commonly referred to as TCJA, that was passed in 2017. So that's approaching 6 years ago. And the provision of that bill, that even though it's called a tax cut bill, part of that bill was to impose a new tax on R&D, but it only went into effect quite deliberately on January 1st of 2022. And so for that reason, the people affected by it really didn't see the effects until now, because right now in 2023, we're all preparing our 2022 tax returns. And all of a sudden, your accountant is saying, hey, wait a second, they've changed the law. The way you used to do your taxes is no longer applicable. And that's a very unpleasant surprise. You can see Allison Bree here is quite surprised. I can tell you my reaction to that change was a lot more significant than hers, because in order to understand the effect, you really have to look at the numbers. And the numbers I'm going to show you are sort of a much simpler way of looking at them than what Jim has, but I hope it's instructive. And what I've done is I've said, for argument's sake, let's use a $100 R&D contract. So and how is that treated prior to last year? And frankly, for all businesses, this is the way it used to be done. And that is, I've got a $100 contract. Typically, I'll have $90 worth of expenses, and those are labor and your contractor costs and so forth. And if I'm lucky, I generate $10 of profit or income. You will not get a federal contract for R&D where they will allow more than 10% profit, and frequently less. And that's fine. For tax purposes, you show I've got $100 of income, $90 of expenses. That gives me $100 of revenue, $90 of expenses, and that generates $10 of income. Now you owe tax on that income, but the $10 you've generated is sufficient to pay some percentage, whether it's 37%, it's different for every company, but you can pay your taxes. That all changed with this new law. So this is the way the law says you must treat your R&D expenses today. And the key thing is that for tax purposes, you now must amortize your R&D expenses. And because SBIR is considered R&D work, even though you're not doing it for your company, you're doing it under contract to the federal government, that all those expenses under your R&D contract are now have to be classified and treated as R&D expenses. And in fact, they have to be amortized over 5 years. And furthermore, there is a provision that says in the first year, you are not allowed to expense or claim expense for more than 10% of those expenses. So we have the same contract. We've got a $100 contract. We have $90 of expenses, which by the time you file your taxes, you've already spent. And now, instead of deducting the real expense you've had, you're only allowed to deduct 10% of that. So you have $9 of allowable expenses on $100 of revenue. Now you show an income of $91 that you have to pay tax on. Again, the amount of tax you pay depends on what bracket you're in. If you're in the 37% bracket, you owe close to $40 worth of taxes, but that contract still only generates $10 worth of income or cash. So how do you pay your taxes? It's a crazy situation where by performing work for the government, you now owe substantially more in taxes than the contract that created that liability allows you to pay. It is the situation that all SBIR firms are in today. And it's not only bad for us, it's also bad for the government who wants that work to be done. Typically, they announce the projects they want to have done. They solicit bids. In the past, in SBIR, there are typically about 10 times the number of proposals that are submitted than the contracts awarded. You know, statistically a 1 in 10 chance. And you have to invest significant resources to prepare a compelling proposal. Now, who in their right mind wants to compete for the right to lose money? There are very few businesses, I think, that will want to participate in SBIR under these terms. And so, in my opinion, and this is just my opinion, if this law stands, this kills the entire SBIR program. And it has nothing to do with the SBIR legislation. There's nothing that people in the program can do to fix it. It has to be fixed by legislation because that's the source of the problem. So where do things stand today? First of all, it is the law today. And everybody I've spoken to, and I'm pretty sure the source advisors guys would agree, say that the only way it can be fixed is with legislation that fixes the problem, because it was legislation that created the problem. Unfortunately, Congress doesn't fix things it doesn't know are problems. And I've spoken to the respective committees on the Hill, and this was about a month ago, and by and large, they're not even aware there's a problem. And that's because most of the SBIR companies are not aware that there's a problem. That's starting to change. We can talk about that. In the last week, I've seen 2 indications that people are starting to wake up. But they not only have to wake up, they have to speak with Congress if there's any prayer of getting legislation through. So how do we fix it? First of all, there's a problem out there, but until we recognize that problem and that it exists and why it exists and what we might do to fix it, nothing will happen. The next thing is, when we say go to Congress, if all the small businesses went to their local congressperson and complained about it or try to get it fixed, that's good, but it's nowhere near as effective as if the firms that want to see this change coordinate their efforts. Typically, that means a lobbying activity, which I am trying to get organized in order to approach Congress and have the most chance of success for fixing the problem. Once we know what we're doing in terms of trying to change the law, and there are a lot of options in terms of what a new law might say. We meet with the right committees in Congress. There's really one committee that means anything, and that's the House Ways and Means Committee, because all tax legislation has to come out of that committee. I've spoken with the chief counsel of that committee, and the approach that I have in mind, he thought was more promising than things he's seen so far that might fix the problem. It may not fix the problem for all industry, which we all agree would be far preferable. But you may not know, if you're not involved with this, SBIR firms may not know that this problem has been recognized by CPAs since 2017. And there have been many efforts to fix it. The most recent effort was in the omnibus negotiations at the end of last year, the end of the last Congress. Unfortunately, all those efforts have failed, and there's a reason why it failed. So I have an alternative theory as to how we might fix it, at least for the SBIR community. And once we go to Congress, if we're successful, and I don't want to misrepresent it, it's not going to be easy. Uh, there's possibility that we can get Congress to issue legislation that at least partially fixes the situation we're all in. Now, there's the more immediate issue, and this is sort of for the tax guys to talk about. People have to file their taxes by March 15th. And how do you do that? What's your interpretation of the law? Part of the problem is that since the law was passed 5 years ago, the IRS has not issued any guidance in terms of how to interpret the law for purposes of filing your taxes. Well, I believe, and the CPAs on this call will speak up and know much more about it. Most CPAs will say, well, the law says you have to do this. And if you do that, you're going to generate a much, much larger tax bill than you can than you can imagine. And you can file that and you can pay that if you can afford to pay it somehow. I know from discussions I've had with other SBIR firms that many of them are planning to file on the assumption that what they're doing for the government is no different than it was before, and that they therefore are going to process their taxes the same way they did before. You can do that if your accountant agrees, and that may not be the case. And you can file, and if you're not audited, that may work for you. But there is always the possibility of an audit. And if there's an audit, and if the IRS says, no, wait a second, you can't do this, you have to do this, or you should have done that. Number one, you'll owe the difference in taxes, but you're also going to be subject to penalties, and you're also going to pay interest on those past due taxes. And if anybody who's followed the IRS knows that they're tremendously backlogged and behind. If you're audited, it might be 5 years down the road, and you will end up owing, if all of these things happen, you will end up paying taxes, interest on those past due taxes over that intervening period. So you will have a huge problem. There is a way you can avoid at least the penalties. I'm not going to get into it because it's really a subject for a CPA to address. But these are things that all SBIR contractors are facing today. And hopefully, if SBIR firms have questions about it, the CPAs who are on this call can answer them. So I'm going to stop by saying, here's my contact information. My interest is to hear from SBIR firms that are interested in collaborating on fixing this problem through congressional legislation. I don't want to be the organizer of that event. Sort of the natural entity to do that is a group that some of the SBIR firms may know called the SBTC, or the Small Business Technology Council. They have been the lead organization in Washington who have lobbied for SBIR reauthorization, for example. I don't know why, but they have been conspicuously silent on this issue. I can't explain why. I'd love for them to take the lead, but in the absence of them taking the lead, I am doing my best to organize an alternative lobbying effort. And if any SBIR firm is interested, please contact me. Obviously, Source Advisors knows everything there is to know about this R&D tax provision, which is generally referred to as 174. And so those are the guys that really know the ins and outs, as Jim demonstrated in his slides. So that's all the slides I have.
All right.
And, I'm happy to answer any
So,
questions people may have.
yeah, we have a couple of questions floating around. I'm just going to post this one because I think that this one came from. Let's see if this will work. There we go. Maybe. All right, there we go. Hal had asked, why was this created in the first place back in 2017? And I bring this up because, and thank you for asking that question, Hal. I bring it up and I wanted Brian and Jim and Dave, even for you to jump in on this. This was something that came out and we've talked about numerous times and what the thought process was behind it. But Brian, can I have you speak to that?
Sure, thank you, Michael. So why do this tremendously counterproductive law change? Well, the answer is pretty simple. It's 2017. You want to pass a big tax cut bill. And they actually did the Tax Cuts and Jobs Act. But you have to pay for it. I mean, technically you don't have to pay for it, but it makes it easier to get votes by having pay-fors, as they're called. So
That's eye-opening,
you
Brian.
so you have to, you look and you think, what can raise a bunch of money? Well, Congress looks at everything in a 10-year budget window. They don't care what happens outside of that. So basically they said, well, hold it. If we switch R&D costs, if we take them where pretty much everyone expenses them, and we switch that to you have to amortize them over 5 or 15 years, and then we delay that so that when we're looking at the budget window, we delay it by 5 years. So the only thing we're picking up is the time when you're going to be generating massive amounts of income. Let's do that. And we have 5 years to fix it. We can throw ourselves our own touchdown pass, in a way of speaking, by paying for this bill now and then fixing the problem later. Well, the fix didn't happen. And so Congress has so far been unable to fix it. Well, not unable, but unwilling, perhaps would be a better way to say, politically unable to fix it. So the law was passed back in 2017, to sum it up, to pay for the big tax cuts from the 2017 tax bill. That's all. Everyone, I believe, had the expectation that it would have been fixed by now. And there's actually decent hope that it will be fixed this year because so far Congress does sound a little less contentious than normal these last few years. And they're also talking about making deals on certain parts of the law. They're definite things that each party wants to come out of a tax bill. Whether that happens is, I mean, if I could answer you that, well, if I had that type of crystal ball, I wouldn't be on this webinar. I'd be on a tropical island somewhere. But it's it's definitely something that could be fixed, probably not before estimated payments are due in March or April, whichever is relevant to you. And that is not the quarterly estimated payments, but the final true up for your return. Because one of the key things about this, the accounting industry itself was somewhat caught unawares. Even though this was known when the bill was passed, we all forgot about it until about 2021 when we started looking up and saying, that law hasn't been changed yet. We should start looking at it.
Mm-hmm.
So if you're a small, medium-sized business in the SBIR space, it's quite likely your accountant didn't hear about this until maybe last fall at the earliest. And more likely it's been over the last couple of months as Congress failed to fix it. So
Can I add something?
yeah, sure.
Please.
I am going to consciously avoid using the words Republican and Democrat because once you use those terms, people tend to separate into tribal camps and it becomes impossible to do anything.
Yep.
The fact is that in order to show that the 2017 tax cut bill was revenue neutral on the deficit, as Brian said, they had to show a new source of revenue, and the one they happened to pick was to impose $115 billion of new R&D tax. And they did delay the implementation for 5 years. And so a lot of people recognize this problem, but unfortunately, um, it was never fixed. I'm going to disagree with Brian because I have had a lot of conversations with people on the Hill. And from what I'm hearing, nobody thinks that the big problem is going to get fixed. And I will disagree that Congress is more reasonable today than it was in the past. I mean, in my opinion, Congress is much more dysfunctional. And that's exactly what I'm hearing from Congress, that they don't expect much to happen this year. And
So,
so given
okay.
that, I'm trying to do something that I'm told has a better chance of passage than an overall fix. I mean, unfortunately, people tried very hard to fix this problem and repeatedly failed, most recently with the omnibus negotiation. And there are
Mhm.
political reasons for that. I'm not going to get into that. But that has not gotten better. And most people will tell you it's gotten worse. At least that's what I'm hearing.
You're right, Dave. I mean, it really depends on who you ask. And there is a sense, significant amount of, say, the lobbyists on the Hill who are saying it's very unlikely that there will be a fix. There's another significant group that says, they're trying to bring a tax title to the floor this year, and they are going to try to attach it to some must-pass legislation.
Right. Of which there's very little this year.
Right. There's really only 5 shots, and one of them, it doesn't really fit, though it'd be great if they could have it in there. And only 3 of them happen before the extended due date. Well, in theory, none of them have to happen definitively ever. I mean, one of them is the debt ceiling limit increase. Well, they can increase that, and yes, they do actually have to do that at some point. But beyond that, every other bill can just be the subject of a continuing resolution to keep things going as is
Right.
until such time as they actually fix it. And we've seen that often enough with Congress in the last 10, 15 years.
Right.
Mhm.
So the real problem is, okay, let's see, we have gotten a couple more questions.
Yeah, I'm going through them. But Dave, in response to what you said, I just want to make sure I understood it. So you're thinking that there's starting to be better exposure in this problem, but it's not going to get fixed in terms of a repeal of it or an extension of it. You're thinking we need to just shift some things and make it more palatable for U.S. businesses.
Well, first of all, let me say that if there is a fix, most people have said the most likely fix would be the simplest for Congress to do, which is simply to say, well, you know what? It used to be 5 years from implementation. Let's kick the can down the road and make it 10 years. So basically, not deal with it for another 5 years. That's the
Right.
easiest thing for them to do, but they haven't even been able to achieve that, despite a lot of people trying very hard. So what I'm saying is, in order to fix the problem, Congress has to deal with the $115 billion of new R&D tax credits that is now baked into the future projected deficit. That's a huge problem that nobody wants to deal with. The people that put it in don't want it recognized that they put it in. And so my political logic, if that's what it is, says, look, the impact of the SBIR program on the deficit is, a pimple. Nobody will notice the whatever amount of money that's lost if they fix that part of the RD tax credit. And at the same time, small business and the SBIR program have bipartisan and bicameral support within Congress. And so, and this was seconded by the Chief Tax Counsel on Ways and Means. there's a better chance of fixing it for the SBIR program alone than there is trying to tackle the big picture. If the Chamber of Commerce and the National Small Business Association and all the accounting organizations have been unable to get this thing done, when it's been known that there's a huge problem, it does not seem, in my opinion, more likely to get something constructive done in Congress this session than last session. I don't want to be political, but they can't even
No,
agree.
no. We don't have to get political, but here's the problem, and I think where we're getting intertwined in our discussion, it's not a research and development tax credit issue. The credit is I don't know, it's a subset of 174. And Jim and Brian, we've had numerous conversations. You could have a company that's never claimed the credit in the past for whatever reason. They're subject to this issue. And I use issue because that's what this is, and it needs to be resolved. But I don't think that it's going to be something that won't be resolved, because it has to be, because this is impacting every business, even ones that are like, hey, we don't have R&D, we don't have qualified expenses, we don't have 174 costs. Actually, you do, based on the definition. And now you're subject to this capitalization, this amortization, and now you have this huge tax bill. It's so messed up right now that I think that now people are becoming more aware of it. Our congressional representatives are starting to recognize it and hear from everybody that they need to understand it and fix it. Before,
I know the AI CPA group has been sending more letters to Congress to address this issue specifically. As it gets closer and closer to tax deadlines, they're asking Congress to become more and more aware of the issue. And I think as more congressional people are aware of it, because a lot of them, I think, have that common misconception that this is dealing with the R&D tax credit, and credits can come or go. And this isn't a credit. This is dealing with your R&D or your research and experimental expenditures. And it has nothing to do with the credit. It's if you are spending money on R&E, you need to look at 174 and see if you're subject to it.
Yeah.
I mean, Michael, I hope you're right. And Jim, I hope you're right. I fear that you're not right. And
I understand. That's why we want to have the open conversation.
What I have seen is that there's a lot of wishful thinking on this subject. Nobody wants to deal with this. Everybody that first learns about this, their initial reaction is, "No, this is crazy. How could this be?" But it is and has been, and it hasn't been solved. So, yes, I hope you're right. But the people I spoke to in Congress, on both the House and Senate side, and both the tax committees, and to answer one of the other questions and both small business committees, the small business committees who are champions of the SBIR program, they haven't even heard of this issue. Hopefully now they will hear more.
That's the problem. They haven't heard about it. They haven't recognized it. We talked to our representatives here in Illinois, and they said, well, we heard a little bit about it, but we're just not up to speed on it. That's the issue. I think once we get more of an understanding and exposure of this issue, it will get resolved. But nobody's going to talk about it, or nobody's nobody's addressed it because it hasn't been an issue until tax year 2022.
One of the things that we strongly encourage for everybody that's listening in on this is contact your representatives, contact your senators, and let them know how this is affecting your business. Talk with your CPAs, run some numbers, and give them real data so that they can see the impact, because the more and more that Congress becomes aware of it and sees that, hey, they always like to brag about how they save small businesses and things like that. Well, the small businesses are the ones being hardest hit on this. And if they're able to say, we were part of the process to fix this issue, to go ahead and save small businesses in America, that's a good political speaking point. And you can help them do that. But until they know that it's a political point that they need to be aware of, there's nothing going on.
Right.
Yeah.
And I agree that writing letters is great. Showing up in person and speaking with staff to try to educate them is better. Um, you know, there's just a lot of lack of knowledge so far on the Hill about this issue. It's also, unfortunately for SBIR, it's complicated because the SBIR legislation and that program comes under the purview of the House and Senate Small Business Committee. This problem has nothing to do with the small business legislation. It's completely a tax issue. Somebody has pointed out, which is useful to know, that the chairman of the Senate Small Business Committee, Senator Cardin, also happens to sit on the Finance Committee, which is the Senate Tax Committee. That could be a valuable resource, but it's all those kind of political connections and how legislation is made that a lobbying firm will do much better than an individual small business writing a letter or even visiting their congressperson. So I hope that we can organize some sort of lobbying activity supported by a bunch of SBIR contractors to approach Congress and inform them about what's not only what's going on, but there's a lot of different ways in which legislation can be written and potentially competing interests on how the solution is implemented. I completely agree that the best solution for the US economy is for the problem to be solved in its entirety. But again, what I'm hearing is that's not going to happen.
So, in answer to this question right here, there is a letter that we've drafted. Um, we do have it on our website, sourceadvisors.com. I will also post it on my LinkedIn, somewhere in my LinkedIn chat area. I'll put it on there, and Source Advisors LinkedIn profile will have it on there, so you can grab it from there. Very general, very to the point of what this impact is. So we will have these letters available for anybody and everybody that wants to use it. Brian, did you have a chance to look at that one question
Yes.
about the end?
Okay. So, well, well, let's make sure it's the right question. The math question?
Yes.
Okay. So there's a question that if you win $1 million in funding and have 250,000 in purchases and 300,000 in outside firms paid as subcontractors, so total 550,000 in costs. What do I pay in taxes? Is it based on my 450,000 that I used to pay my employees and take profit? And there's a key part of that equation missing, because how much you pay your employees would also be added to that 550,000 in research costs.
Mm-hmm.
And if assuming that away, I'll give you an example. You have 550,000 in costs and $1 million in income, let's say. Therefore, you have only 1/10 of those costs to take against that income, or 55,000. So the government tells you you have $945,000 in profit this year, and you have to pay 37% of that, let's say, in taxes, or about 300 some thousand. That is, that's horrible, because if you, the questions that we get from small businesses usually go along these lines. We ask them, okay, some questions, and we say, this is what looks like you're going to end up owing in taxes after this change. And it's a big number, and we say, first question is, do you have cash to pay that? And if not, what do you have to do? Can you go back to the bank to get a line of credit? Can you go into the IRS to get an installment agreement to pay the taxes? And the unfortunate part is, you really can't go in 3 or 4 years in a row to get additional installment agreements from the IRS. At some point, you have to figure out a way to handle this. I've seen in the comments that some people say maybe we should just turn down awards.
Yeah.
That's, David can speak to that better than I can. The real problem is that there may be ways to get around this for some businesses. One thought is that if you're not at risk for the payments that you're getting from the government, that, if you're in a cost plus situation or time and materials and all of your costs are funded, that you're not at risk for them, which is why a lot of SBIR firms do not get the research credit because they're not at risk for their costs.
Right.
And so there's some thought that maybe you can use that same type of logic to continue treating yourself as a service provider. That would definitely be a stronger argument if you didn't have any rights to the resulting IP. But again, it's a situation from what David has told us where it, you may actually have rights to that resulting IP, and that's part of the upside of the SBIR program, is that you get to exploit it at some point. So it's really, in some cases, SBIR captures the worst of this situation, the worst of this law change. It is, you don't get the research credit to help offset your research, your taxes from this, but you have to amortize perhaps. And the problem with amortization is, even if you find a way to, your CPA says, okay, I've figured this out here based on your facts and circumstances, this is what you can do. There's no guarantee that the IRS will accept it. You can disclose the position, but if they don't agree that you have a reasonable basis, which is a technical tax term, they may just ignore that. So it's possible that, you could end up with penalties no matter what you do in your best intentions. Now, that's unlikely given the uncertainty of the law. And latest we're hearing is that the IRS itself isn't going to release any guidance till at least after April 15th, and more likely much later than that. So, I did want to circle back to one thing. We tend to have a more optimistic view of the chances for this passing because we all come on the tax side from a research credit background. For 35 years, the research credit was a temporary measure before Congress made it permanent. So every 2 to 4 years, we were used to, sometimes every year, we were used to, okay, how does this get through Congress? And so to the extent that they look at this, they being Congress, look at this as a research credit issue, which isn't true, they may just be viewing it as, okay, we can pass this anytime and fix it. People go back, amend their returns. I think that explains some lack of urgency on their part, because this is something we've seen repeatedly in history. The research credit, except for 6 months in the mid 90s, has been consistently extended, expanded, and sometimes even retroactively extended over the last 40 some years. And as time has passed and Congress grew more contentious, retroactive extensions were very much the order of the day until they made it permanent in the middle part of last decade.
Yeah.
Can we address one issue that I know has confused me and frankly I believe many non-CPAs, and that is the difference between the taxes that an SBIR company has to pay in conjunction with its R&D activities, its R&D expenses, and the tax credit, because those are two separate things. And as you guys know, because I passed you a notice that the DOD SBIR office issued last week that sort of implied that, well, don't worry too much because you can offset your massively increased taxes with this tax credit. And I don't believe that's true. In fact, I've gotten feedback from some people saying, well, I think this is an issue because I can do that.
Section 41 of the Internal Revenue Code is the research credit. Section 174 of the Internal Revenue Code is the amortization of the R&E expenditures. Okay, so we're dealing with two different code sections. The research credit has a 4-part test that has to be met in order to qualify for it. The first part of it says that the expenses have to be able to be classified as R&E expenditures underneath 174. And then there's 3 other parts that you have to go through to qualify. 174 is therefore broader. It doesn't have those other three parts of qualification. And so qualifying as an R&E expenditure underneath 174 is much broader. Currently, it basically means anything incident to the design or development of a product or process, or anything in connection with software development. And that definition is much broader than the research credit. Research credit has that 4-part test plus a whole bunch of exclusions, including funded research, where you have to have the rights and risks underneath the contract. 174 does not address rights and risks beyond what Brian mentioned earlier. And so when you're looking at the credit, it's based upon your qualified research expenses that you can take underneath that 4-part test. When you're looking at 174, you're looking at your research and experimental expenditures, meaning the items that you've expensed to develop these products and processes and software.
So let me boil that down to my understanding and ask you if that is correct. If I'm an SBIR contractor, I have to file my return, and the expenses are treated under 174, and I've shown what those are.
Mm-hmm.
Is it true that an SBIR firm trying to apply the R&D tax credit is not going to, that credit, if you even qualify, given all the conditions, is not likely to offset the increased tax that you now owe compared with last year? Is that a fair assessment?
The credit will be less than the amortization in 2022. Over the course of several years, the credit's going to help you start getting ahead on your taxes. By year 4 or 5, depending upon your tax situation, you'll start seeing the credit getting you to a refund point of view. And then from there on, the credit's going to be beneficial because the amortization works where year 1, you only get 1 year's amortization. In year 2, you get part of year 1 and part of year 2. In year 3, you get part of year 1, year 2, and year 3. And so after 6 years, you've got this rolling amount of amortized costs coming in and the credit on top of it. So that's kind of where we stand with that.
And
right.
That's just, sorry, Dave. That's just looking at the cash flow for each year.
Right.
To actually be made whole and setting aside the time value of money,
Right.
you're looking at 11 years before you're sort of made whole.
Right. And it also assumes that the small business survives that 6 or 11 years to recoup that. And I know in my case, where essentially 100% of my revenue comes from a single SBIR award, that ain't going to happen.
So there was a question that came up about the what qualifies as a taxable cost. And so I just want to add in this section right here, because what we're talking about is not just 41, which is for the credit, research and development tax credit, but the focus of this conversation is on the right-hand column, and it's whatever costs you had from the R&D tax credit, in addition, all these other costs. So it's not limited to the credit, whether you're claiming the credit or not.
There was a quick question that came in that says, what if the contract only lasts 3 years? You are still required to amortize each year's expenditures over the 6-year period.
Mm-hmm.
Yeah. And then a question came up earlier, directed to me on LinkedIn before the presentation. And their question was, what if they sell their business? We have a couple of businesses that have come to us and said, we sold at the end of 2022, even before that. How does this impact them? Because that's also a pretty big issue in terms of, am I amortizing, not amortizing? What do I do? And possibly for the small businesses.
Brian?
That's a very good question. And the issue is if you sell in a stock sale or the equivalent, then the business just keeps on amortizing it. It doesn't
Okay.
affect you. But if you sell in an asset sale, the way it's written is you keep amortizing that cost even though you no longer have the business. And the extent to which you can even use that amortization deduction, it almost seems like technically an area that needs a technical correction from Congress to even work, because having to amortize something for business you've sold makes very little sense. But it also doesn't make any sense to have to continue amortization when a research project has been sold or scrapped off on its own,
Yeah.
which is definitely the case.
I'm going to put up this question because this is another appropriate one for this conversation. And it's a big concern for a lot of software companies that we talk to. Jim or Brian, you want to speak to this?
Yeah, if you are developing software, it now applies to all software. The official rule that SK put up is, for purposes of this section, any amount paid or incurred in connection with the development of any software shall be treated as a research or experimental expenditure. This is new for the code. Previously, it didn't specifically call out software. And with the new 174 code, it now does. That being said, software is defined very clearly. Development is not. So you have to go to the facts and circumstances and figure out where software development ends and begins, or begins and ends. Once it stops and you're just doing debugging or routine maintenance or something like that, or quality control testing, or items like that, you don't need to consider those 174 costs. If it is the actual coding and testing and programming and things like that, that is going to fall underneath 174. And essentially now it doesn't really care what the software is for. It's doing more of an activity-based analysis for it.
Yeah. David, what else have you heard from lobbying efforts? Have you heard anything else, like from the small business side, and even large business? Has anyone heard anything else? And this goes out to the audience as well. Has anybody heard anything in terms of additional efforts being made beyond what we discussed today so far?
Yeah, I reached out to the organization that typically lobbies Congress about SBIR, which is this organization called SBTC, which is affiliated with the National Small Business Association. Their membership, and you have to pay to be a member, so this is not all SBIR companies, have been aware of this internally, but they have been, in my opinion, reluctant. And this is one of the weird things about this situation. The people who most are the biggest champions of SBIR, such as SBTC, such as the government program managers within the government who run the SBIR efforts within their agencies, they have appear to be reluctant to promote awareness. And the reason is these guys largely are in business to promote SBIR.
Mm-hmm.
And unfortunately, this situation is a big detriment to SBIR, and they're not anxious to promote information that causes firms to second guess whether they should participate or not. I think by ignoring the issues, people are doing what I call the ostrich approach, which is, if I stick my head in the sand, maybe this problem will go away. That is starting to change. I sent you guys and some of the SBIR companies online may have received an email blast from the DoD last Friday, in which, for the first time, they're trying to make their contractors aware that there is an issue that they have to be aware of. But as you guys know, if you read what they sent, they sort of gave the impression that these tax credits are somehow magically doubled by some other legislation, which turns out not to be true. So they try to put a positive spin on it that doesn't exist. And that's, in my opinion, that's not productive. It's misleading people, unintentionally misleading people into thinking they have less to worry about than they do.
It was an interesting wording of how they did that. Um, and from a marketing perspective, I could see that approach. But Jim and Brian, I know when we looked at that, it wasn't a doubling of the credits.
No.
It was a doubling. Let's talk about this because
There's
it's for startup
two
businesses.
versions of the credit. There's one that goes off against your taxable income, and there's one that offsets your payroll taxes. The payroll taxes, you have to go through more hoops, but allows people that don't have taxable income, they have net operating losses, to use the R&D credit. That credit, the payroll credit, has historically been capped at $250,000 per year. In the Inflation Reduction Act, they raised that cap to $500,000, but that doesn't mean that you automatically get the $500,000. You still have to have the research expenditures and everything else and go through the math to get up to there. And then you have to have the payroll taxes to offset that against. And if you don't have the taxes, you roll it over to the next quarter, to the next quarter, to the next quarter. And most SBIR companies don't have $500,000 in payroll taxes in a given year or something like that. It's going to take a while to use that credit. So it's very misleading, the letter that they sent out saying that, here, this is going to help offset 174, when you're only going to be getting a fraction of that credit back at any given point.
And I'll give you some insight into the mentality of the people that created that, because after I got your feedback saying, hey, you know, this statement they made is actually misleading. And I actually got comments from other SBIR contractors that say, hey, I read this as saying this is nothing to worry about because I can use this RD tax credit to offset the increased tax. I wrote to the woman who runs the entire DoD SBIR program, and I said, look, first of all, it's great that you're telling people that there is an issue they have to be aware of, but I just want you to know that your statement about this double tax credit is not accurate and frankly is misleading. And she wrote back saying, well, you know, we did say you need to talk to an SBA, a CPA rather, to really understand what's applicable, and that is true. But if you look at the body of it, 50% of the text is this positive sounding solution to the problem because they're inherently biased towards promoting the program.
Yeah.
And
I like the positivity. I'm in favor of that. Being a positive person, love it.
right.
I prefer the positiveness be on accurate information.
Correct.
I don't think that's just me. I think most people would be positive. Yeah.
Yeah, I know. And she did not take kindly to my comments.
Imagine that.
But in fact, she wasn't intending to mislead anybody, but by being positive about a bad situation, effectively that's what happened, at least with some people.
Yeah. Yeah. And yeah, I'm with you on that. Thank you. I appreciate this. This is so LinkedIn Live, we usually broadcast 20, 25 minutes is the length of time. We're an hour, 10 minutes into this. And this is clearly a very big issue that needs to be resolved, which is why I asked Brian and David and Jim to stay on to answer questions, talk about this, have a thoughtful conversation about this, and bring more light to what's going on. It has to be resolved. That's what the end of all this means is we have to get this.
That's going to kill a lot of companies.
Really, it's devastating. And we've talked to other CPAs, we've talked to businesses, and we've talked internally about this. We've never seen any tax law like this that is literally hurting the U.S. industry, the U.S. businesses. People
well, let me ask
are being
you guys
negatively
impacted. Since you've been dealing with it longer than me, do you find that people, when they learn about this, have a hard time believing that it's accurate?
Depends
so
on the
crazy.
company. Some companies they understand that Congress likes to pull the rug out from underneath them sometimes. Other companies are very disbelieving at first, and when they finally realize it after talking with their CPA that the information we're providing is accurate, they sit there and go, it's devastating to them.
Yeah. And it's not the fault of the CPA. It's not the fault of us or any R&D consulting firm. It is literally our congressional representatives that threw this out there, like Brian said, and said, figure it out later. And this is the later.
SK, if you want to talk to us about R&D tax credits after this webinar, just go ahead and get a hold of Michael Wardy. You can, he'll put up, do you have the slide with the contact information? If you don't, that's fine. You can email us at, there it is.
Yeah.
If you want to talk R&D tax credits, get a hold of Michael. He can definitely help you out there.
Yeah. We'll set up a time to talk further about it and give some insight and guidance at least.
Yeah.
Yeah. All right, everyone. I know we went way over, but again, it's too important to shortcut this conversation. So we appreciate everyone joining. If you do have questions, further questions, reach out to myself, Jim, Brian, David, reach out to us, reach out to your congressional representatives, share this video, this broadcast. It'll be on my LinkedIn profile so you can repost it, share it with anybody that you think, hey, you need to know about this because it's a big issue, because it is. And we definitely need to make sure everyone's aware of this. The recording is available. It'll get uploaded right onto LinkedIn and our YouTube channel, Source Advisors YouTube channel, and on Twitter. So we will have it available for everybody to go back and refer back to, review. Have questions, thoughts, comments, reach out to us because that's what we're here for, is to help give the right guidance and the best information so that you can make right business decisions. Thank you, everyone, for joining. We really appreciate it. One last point. I apologize. Okay. We're all good. Thank you, everyone, for joining. We appreciate it. Be well.
Bye-bye.
Thank you guys for joining too and being a part of this.
No problem.
You're welcome.
Bye-bye.